Hi, it's Amelia from Market Compass. I thought I'd put together a little video for you today just talking about what's going on in the economy and also the financial markets. If you're looking at headlines, which I'm sure you are, there's no way to avoid them, and looking at markets, just putting everything into context. Just so you know, my background is an event risk specialist. So I was on Wall Street for 17 years. I started my career at the Federal Reserve Board in '98, which was Asia financial crisis. Then at Deutsche in 2000, 2001 for the tech bubble burst, which was the U.S. recession. 2008, which was a U.S. and global recession. I was still on Wall Street working away. That was also the European banking crisis, the Greek debt crisis as well, if you remember that. So I've seen a lot of, I've worked through two recessions at least. I was very lucky, fortunate to keep my job throughout both of those. So now we're looking at a big U.S. slowdown. As you might have noticed, you can follow me on Market Compass, and I do update this in my IG stories. I try to keep track of it. But I'm sure you've seen all over the news. Obviously, big retail stores are closing in the United States. Social distancing is what doctors are encouraging. So retail stores and gatherings are either closing or not taking place to limit the spread of coronavirus. So coronavirus is the external shock which is hitting the financial markets, also communities and people, individuals in terms of health, and also the U.S. economy. That's what we call an external shock, something that comes outside of markets and data. So with all of these retail store closings, I mean, Nike's closing nationwide, REI, Apple as well. Certainly your community, your city may be affected even more or less, depending where you live. New York City is impacted almost to a halt. Gyms are closed. Broadway is closed. They have a limit now. I think also in the tri-state area of restaurants are closing and you can only have takeout or delivery. And that's the same in Los Angeles as well. Bars and clubs are also closed. Major sporting leagues, professional sporting leagues are closed or they've suspended play indefinitely for the season. NBA, NHL, PGA. I had tickets to PGA Players Tournament, Players Championship last weekend, and that was canceled. Even if you want to spend money to go to an event, you may not be able to because the event's been canceled. Retail spending is taking a hit. This is disproportionately impacting small businesses. I'm sure if you're a small business owner, you learn that very quickly. You're experiencing it now, or you may in the future. It does depend what type of business you have. Of course, consumers in the U.S., I'm only going to speak about the U.S., have the option always to shop online. I'm sure probably Amazon and Netflix right now is doing well with the kind of self-quarantining, social distancing going on. That doesn't mean consumers are necessarily spending online. There could be a loss of consumer confidence when you hear about the virus or you hear about the economy slowing. You may be more careful with your spending. You may not buy that discretionary item because you're kind of retrenching in your spending and want to stay liquid, want to stay in cash, don't want to give it away. Why is it such a big deal? If consumers stop spending, well, in the United States especially, it's a big deal because consumer spending is 2/3 of U.S. GDP. So when consumers stop spending or slow down or are prohibited from spending because retail stores are closed and events are canceled, that takes a massive hit to consumer spending, and GDP subsequently takes a massive hit. So in my opinion, it's likely we're having a large economic slowdown right now that could turn into recession. The easy definition, the simple definition of U.S. recession is 2 consecutive quarters of negative GDP growth. And the NBER, which is the National Bureau of Economic Research, they date recessions in the U.S. using a different method, peak to trough drawdowns in various activity measures. And so while that's a technical recession, the slowdown may or may not be a technical recession, but that's really neither here nor there. We know that the U.S. is slowing down, and during a massive economic slowdown or a technical recession, these recessions or slowdowns don't determine who's right. They determine really who's left. So certainly small businesses are getting hit. The consumer is getting hit. And soon in the data, we'll start to see job losses. I'm just looking at a chart here of the Dow Jones Industrial Average. We opened very negative today, down over 2,000 points, and trading was halted. We're here through the 2018 low. We broke that support today. And that's bad. It opens up maybe 20,000, 19 and 18,000. We have a low here in 2017 of 20,404, which would be the next support level. Sunday afternoon, 5 p.m. Eastern Standard Time, the Federal Reserve Board took a second extraordinary measure, meaning the second emergency policy meeting in less than 7 days. And they cut interest rates, the Fed funds rate by 100 basis points down to 0. They also did some other measures in terms of dollar swaps with other central banks and some bond buying. All of this was done to support liquidity in the market. I'm not saying that the Fed was wrong to do that. I think it's best to take massive action ahead of time, even before we see the slowing in the data. It's possible they have data already which shows slowing in the economy, and maybe that slowing is larger than we think, and that's why they took such massive action. We know financial markets are dislocated, and so they need to stop the seizing up of markets in the banking system. So certainly it's better that they be proactive. However, their large, massive action last night, which is somewhat unprecedented, I just want to impress upon you that if the Fed moves in an emergency way between meetings, these are things we haven't seen since 2008. That means that the markets are bad and that the economy is slowing, okay? Otherwise, they wouldn't do this. The reaction to this on Wall Street today was it a bit freaked Wall Street out, and equities are down very heavy. Equities are down across all sectors, which is telling me and other traders and analysts that I speak to, very experienced people in the markets, that investors and traders are just selling everything. Meaning what does that mean? Obviously, they're selling everything if every sector's down, but they want to stay liquid. So liquidity is very, very important here. And I urge you as well, even if you're not a trader, to, in these times of huge market dislocations, to try to stay liquid, try to have cash, reserves, savings if you can have them. People have been writing and asking, all of the financial experts, you see it all over, is now the time to buy the dip? And it's really hard to buy the dip when you're kind of catching a falling knife here, is what we call it. You're seeing large 1,000-point drops in the Dow. It doesn't mean you want to get out of your investments and hold cash. This is now an opportunity to possibly pick up selected equities over a long-term period. And when long-term, I mean 5 to 10 years for a retirement account. I don't mean 5 months to 2 years. I mean long-term, 10 years. And why do I say that? Why do I say now is not the time that equity markets will stop falling? And the reason why is because volatility is so high. This is a simple answer to that question. This is the VIX index. This is the measure of volatility in the S&P 500. 20 here, the horizontal line, is when traders usually say things get volatile when it spikes above 20. You see the spikes here. January 23rd, this blue horizontal line, was when we really started to hear about coronavirus from the World Health Organization. That's when they started posting about it on their website. And at that time, the coronavirus was only in China, and it subsequently spread to Asia, Europe, and the United States. And so when it was only in China, when it looked like it was pretty well contained, the VIX was still low, below 20. When it started to spread to greater Asia and Europe, the VIX exploded above the 20 level, and you see we're up here at 78.71. So if you're trying to buy equities, when the VIX is at 78, which is highly volatile, you're in for a roller coaster ride in the short to medium term. The markets are roiling, and it's going to be all over the place. So, if you're looking for a more medium-term buy in equities, you shouldn't do that until the VIX subsides, volatility subsides down to 20 and below. If not, you're just in for a total roller coaster ride. Lastly, I would say, based on my own experience in markets, if you have a job, keep your job right now. If you're in the process of looking or switching jobs, you may want to make sure it happens very quickly if you can. If you have an outstanding contract that you're negotiating or want to sign in terms of a new workplace, make sure it gets signed right away if you want to work there. Switch jobs, simply because once the economic data starts coming in, that's quite bad. I've had this happen to me before. A job offer can be rescinded. So you want to get that tied up right away. Same thing if you're, if you own a business, any client contracts, they can disappear in a second. So you want to get those buttoned up as well as soon as you can. If you're in a real estate transaction, same thing. If you need to refinance your mortgage rates are low right now. Over the past week, mortgage rates have actually risen in the United States. I was at a conference a week and a half ago and talked to some banks there. And the demand for refinancing mortgages, refis, is so huge that the banks can't process them in a timely way. And so they're charging a bit more, meaning interest rates are rising on the mortgage rates because there's such huge demand out there right now. They're also creeping up because there's dislocation in markets, which makes it riskier for the bank to lend to anyone right now. They're taking an assumed risk because markets are so unstable right now. In any event, the positives out of this are hopefully this social distancing will limit the spread of the virus. You know, the U.S. economy is very, very resilient. The U.S. worker is very, very resilient in terms of the workforce. The workforce of the U.S. is currently still able to move around the U.S. and work in different sections and regions. We'll see if that disappears near term, hopefully not. But the other thing we have is great technology. I'm sure you know somebody who's now working from home. And so the ability to do that is just amazing with the new technology and holding Zoom meetings. This morning, for instance, I went live on a webinar in Chicago, and we were on TV there. And, you know, it was easy right from my living room. So things like this are amazing, and they make the U.S. workforce really flexible. If you want to know more economic updates, subscribe to my free content on marketcompassllc.com. You can watch my Market Compass Instagram stories at Market Compass, and that's when I update with a lot of headlines as to what is going on. And it's not to be alarmist. This is just to educate people and traders so they can stay on top of the news if they're trading, which is very important to do if you're actively trading. At Amelia Bordeaux on Twitter. And I have a monthly macro event risk webinar. We go over global event risk and how it's impacting markets and looking at trading opportunities. And so that's being held Wednesday night. You can sign up on my website if you go to the webinar tab.